we're finally getting some clarity on the long-term outlook for popular covered call ETFs. And I'll admit, I've been critical of many of the high-yield covered call ETFs that have exploded in popularity over the last couple of years. And many viewers have been critical of me. I'm talking about things like JEPQ, many of the ETFs from Roundhill and Yotmax, and others like them. My main three criticisms were that their flawed structure would lead to an unattractive risk-reward profile. Their income payments would decline over time if investors didn't reinvest them, and they would be subject to significant NAV erosion. So what's changed? Well, I also said they wouldn't really start to show their true colors until they went through a downturn and subsequent recovery. And now they have. So let's see how some of the most popular ones have been holding up. We'll start with NASDAQ and tech-oriented covered call ETFs. Here we have the QQQ in blue representing the NASDAQ, with QDTE from Roundhill in red and JEPQ from JP Morgan in green. This is total return with dividends reinvested. Exactly as I expected, both covered call ETFs held up slightly better on the downside, but then it lagged massively on the upside. For the full period, QQQ is basically flat, up 0.03% or 3 basis points, but QDTE and JEPQ are both still down about 5%. Why? Let's start with the left side. Their downside protection is largely overrated. Covered calls lead you with capped upside and unlimited downside. The only downside protection comes from the income. That would work great if the market went down like 1% every month for 2 years, but that's not how downturns usually happen. They go down much faster. For an ultra simple example, think of it like this. Something that gives you a 12% annual yield will pay about 1% per month, right? So if the market goes down 20% in 2 months, the covered call ETF should go down 18%. You've only gotten 2 months of income. There's no other downside protection. And if you don't reinvest your dividends, you can't expect any downside protection from most covered call ETFs, unless their underlying portfolio is actually more conservative than the benchmark is, like JEPI's is. The right side is the bigger issue, though. All covered call ETFs are managed a little bit different as far as what percentage of the portfolio they write covered calls on, how far out of the money they are, and so forth and so on. But in general, they're all capping the upside in their underlying investment at some point. So the reason they will tend to fall behind in recoveries after a downturn is because just like downturns don't happen gradually, neither do recoveries. Usually they happen rapidly with some big up days or up months in there. And so covered call ETFs end up getting up way more of the long-term upside than you would think. This chart from Hartford does a great job of explaining why. In the stock market, way more of the long-term returns than you'd think come from just the best few days. If you'd missed just the best 30 days over the last 30 years, you would have ended up with 83% less money than if you just stayed invested. 83% of the returns came in 0.4% of the days. Now, covered call ETFs don't cause you to miss all the returns in a great day, but they often cause you to miss a lot of them. That becomes a problem over time, as we saw with the last chart, and that was just a couple months. Over 10 years, the impact can be massive, and that gets us to NAV erosion. If you'd been taking out the income, this is what the value of your position would have done. -8% in JEPQ and -12% in QDTE, even while the underlying investment they held was basically flat. If we go back to QDTE's inception just over a year ago, JEPQ has fallen 2% and QDTE has fallen a whopping 26%, all while the NASDAQ, represented by QQQ, was very solidly positive. And why does that matter? Other than just that the value of your investment will decline over time if you take the income? Because that will cause the income to fall too. It's pretty simple. The yield percentage will move around with the volatility of the underlying asset over time, but usually stay within a broadly similar range as long as the ETF doesn't change its process. When volatility is higher, the yield will be a little higher because you get a higher premium on covered calls. And when volatility is lower, the yield will be lower for the same reason. But we can't buy groceries with percentages. Percentage of what, right? Of the NAV. The actual income you get paid is the yield times the NAV. So If the yield percentage is broadly similar over time, but the NAV is gradually declining, what will happen to your income? It will decline over time. It's simple math. 10% of 80 is less than 10% of 100. So let's start with a real-life example of JEPQ. JEPQ's highest yielding month was all the way back in 2022. But in general, we actually haven't seen this declining income effect much in JEPQ. There are two reasons for that. Number one, because JEPQ has basically only existed in a massive bull market for tech stocks. And number two, because recent extreme volatility has caused the yield to temporarily tick back up the last few months. The declining yield comes from NAV erosion, and JEPQ, with its 12 to 13% yield, hasn't really had NAV erosion over its lifetime, since the NASDAQ has been up over 57% during that 3-ish year period. But that's what it took for the NAV to increase by 2.6%. Unfortunately, the NASDAQ will not always rise 15 to 20% per year like it has since JEPQ's inception. With more volatility and/or more modest returns in tech stocks closer to their long-term average, NAV erosion is likely to get worse and the income is likely to fall gradually over time. QDTE, on the other hand, with its much higher yield and weekly payouts, has already seen significant NAV erosion and rapidly declining dividend payouts. On April 24th, 2024, it paid out 33 cents. On April 24th, 2025, it only paid out 24 cents. And that was with way higher volatility this April than last April, meaning the income should have been higher this year, but it was actually 27% lower after just 1 year. 1 week is just 1 week, but if you look at the last 4 weekly payments of this year versus the same payments last year, that month of income has fallen by 25%. So the income is way down and the NAV is way down, even while the NASDAQ, which QDTE supposedly tracks, is up a lot. That's just not a great deal for investors. And over 10 years, if the ETF even makes it that long, this is likely to look a lot worse. It's not a viable retirement strategy because of the declining income and account value. And it's not attractive for younger investors because you end up capturing more of the downside than the upside. If you want to invest in the NASDAQ for the long-term upside potential, I suggest doing so without the covered call exposure that limits it. Pure NASDAQ exposure would also be way more tax efficient through an ETF without covered calls. So let's dive into a few others, not the concepts again, but the results. Our video on RDTE, the Round Hill Russell 2000 Small Cap Covered Call ETF, which we put out right after its launch, was one of our most disliked videos. People didn't want to hear the warnings, so let's see how it's held up with its ultra high yield and weekly distributions. Starting with the total return since inception, here's IWM, the iShares Russell 2000 Small Cap ETF in blue and RDTE in red. It's performing pretty much like I'd expect it to, given the environment we've had. Covered call ETFs should do better than their underlying investments in flat or slightly declining markets, which is what we've been in most of the time since its inception less than a year ago. It's actually ahead of IWM since inception if you'd reinvested all the dividends, though we haven't really come close to the recovery period, which is when I really expect it to lag. If we just focus in on the period where there has been a downturn and subsequent recovery, it's behind by almost 2% in less than 2 months. And all of that has come in the recovery period. On the other hand, if you'd been taking out your dividends, you would have experienced almost 19% NAV erosion, while IWM was basically flat. And that would have resulted in broadly declining dividends. Put differently, if we just compare its first 17 dividends with its last 17 dividends, we'd see that 10 of the first 17 payments were over 30 cents and none were under 20 cents. The most recent 17 payments had only 4 over 30 cents and 5 that were 20 cents or lower. So to sum it up, in RDTE, total return has been better than its index since we've had a lot of flat or declining markets, but it remains to be seen if that will still be true after the full recovery. And we have seen significant NAV erosion and declining income payments. Here's another one we've done a video on, TSLY, a covered call ETF from YieldMax that just buys Tesla stock and writes covered calls on it. This was almost exactly 1 year ago. So let's see if its 87% yield was too good to be true. There are 3 ways you can look at it. You could say, hey, a 45% 1-year return is pretty amazing. That's what TSLY did in red. Or you could say it trailed Tesla stock by over 50% in a year. And if you expected an 87% yield to mean and 87% total return, you would also probably be pretty disappointed. This is another one that has performed pretty much exactly like I would have expected. Obviously, I can't predict a company's 1 year stock return, other than to say it's probably not that likely to double very often. But what I can predict is how a covered call ETF like TSLY is likely to perform relative to its underlying stock, depending on how the underlying stock does. In this sense, it's done exactly what I would expect. Let's look at it piece by piece. When the underlying investment is relatively flat, I'd expect a covered call ETF to do better, and it did. Unfortunately, the only way you get to an 87% yield is by using an underlying investment that's rarely very flat, and it rarely was. In big upswings, I'd expect it to lag significantly, and it has. And in downturns, I expect it to do better, and it has. But all of this is just showing total return with dividends reinvested. That is the key. If you had not reinvested your dividends, you'd have experienced significant NAV erosion over the past year, down 39%. Even allowed Tesla stock practically doubled. It underperformed by over 100% in 1 year. That income you received, where people were projecting out, oh, wow, with my $100,000 investment, I'm getting an income of more than $7,000 a month. That's just simply not sustainable. I'm guessing you don't need me to make any arrows, boxes, or calculations to see how much this income has been falling. And TSLY has only been around for 2.5 years, and Tesla stock has done great in that time, up over 87% in a couple years. I probably don't need to tell you that those are better long-term returns than you can expect in really any stock. And still, TSLY has had over 75% NAV erosion, meaning if you invested $100,000 in TSLY and took out the income, your investment would now be worth only about $22,000, with almost no chance to recover. And now, your income payments are less than half of what they used to be. So where does that leave us? Something like TSLY with its 87% yield is an extreme example, but it's simple math. The more your income exceeds the long-term expected return of the underlying investment, the more NAV erosion you're likely to have. Think about it. How can you take out 20% per year of income from an investment that returns 10% per year? You can't. It's return of capital. They're effectively just giving you your money back. If that happens and you're taking out all of the income, the NAV will erode over time. And since the income is based on the NAV, the income will also decline over time. I know a lot of you are probably not convinced yet, but I strongly urge you to think about how this might play out over a 30-year period where you might be retired. No matter how well an investment has done the last 3 months or 2 years or however long it's been around, really ask yourself, is it always likely to do that well? What's the long-run average return on the stock market? Around 10%, right? And how many large cap stocks, like ones that are already among the biggest ones in the world, that are already well established, have ever continued to generate 20 or 30% annualized returns after becoming one of the biggest stocks in the S&P 500? Zero. None. It's never happened. Sure, you can find a stock that's done well over the last 20 years from when it was like a penny stock, but how many covered call ETFs do you see on penny stocks? Not that I'm suggesting that would be a good idea, but looking at short-term past returns and projecting them out into the future is the number one investment strategy that has been proven to consistently fail over time. I know it's tempting, and ultimately, this is not advice, and it's your money, your choice, but I would strongly encourage you not to do that. And last thing, this channel is run by Kyle and Ethan. You can join our free Discord with over 450 active members in the link below. Thanks for watching, and we'll see you in the next video.